In today's video, we are going to look at a product and strategy that is used by a lot of corporations when it comes to whole life insurance products set up for maximum cash value. However, we'll show you how individuals use this product as well. So when it comes to corporations and wealthy individuals, it's not a secret anymore that they use cash value life insurance. And the death benefit does provide a long-term benefit in terms of legacy planning. However, the cash value provides a huge benefit as far as being able to use the cash value for opportunities in my business. Maybe it's real estate, whatever it might be, I can use it. That's the attraction there. And of course, if I can maximize it more, that grants me more access to capital and I lose less money up front. Specifically, when it comes to a whole life insurance policy, what everyone hates about it is often the first year, where I've got that negative hit. So how do I minimize it as much as possible? So what we're going to look at today, we'll have a lot of fun with this, is an Executive Strategies whole life insurance product. This is a type of high early cash value policy that is typically used among corporations. Now, how corporations typically use it, let's say you are a company, you're a business, and you're going to take out policies on 10 executives. The requirement for a business when taking out policies on executives, if they say, okay, we want this product because it provides rich upfront cash values, it does not negatively impact their balance sheet. For a company, the minimum base premium is $50,000 per year. That's the minimum requirement if there are policies on more than one individual. So for example, if there are 10 executives, then the average base premium would be $5,000 a piece times 10 executives gives me a total of $50,000. If there are two owners at a company or two individuals at a company, then the company owns the policies and is paying the policy premiums, then the minimum premium would be $25,000 each or $50,000 combined. That is for a corporate-owned policy where the company owns it and there's multiple individuals involved. If it's a case where one individual is taking out a policy, which is often when we use this policy, it's one individual we are working with, the minimum base premium requirement is $100,000 per year. So if I'm looking to pay $100,000 per year into a policy, if that's the maximum I ever want to pay in, I would not recommend this product. I would go with a different product where I could have a minimum base premium of $10,000, so I'm only committed to 10 and can pay an additional 90 in PUAs and accelerate the cash value growth. That'll be much more efficient. However, if I'm looking at larger dollar amounts going into a policy, this product can make sense. So a couple bullet points here is one, the first year cash value on the base premium component is 95%. So what that means is of that $100,000 base premium, guess what? You're going to see $95,000 show up in cash value in the first year alone. So it's very cash rich initially, hence Executive Strategies, a policy that's typically offered to executives. And if a company owns the product, that 5% hit is a minimal impact on the balance sheet. So it does not hurt companies as much as other traditional whole life insurance products. But for an individual looking at higher dollar amounts, I get strong upfront cash value and it does not hurt me long-term either. Most traditional high early cash value products like MassMutual's high early cash value is great for strong upfront values, but long-term is not as attractive. So with that said, if my goal is to maximize performance, maximize the cash value specifically, the funding typically needs to be a minimum of $500K per year. What that means is I've got the $100,000 base premium requirement and then another $400,000 per year going into PUAs, or the ability to pay at least another $400K per year into PUAs. And a lot of times it's more than that. Why I state that is if I go with this policy with that minimum base premium of $100K, and let's say that the maximum you pay in is $300,000 per year, or on any given year, you'll see decent cash values up front and long term, but it will not be maximized. you would have likely been better off going with a more traditional product that had a $30,000 minimum premium, and then you could really stuff the policy up to $300K per year. And we do have some case studies that provide a comparison for individuals that have went with this product. We like to provide that analysis because it's a nice product to be aware of. But if that $500K or more seems like a stretch each year, then it might be an option where I say, okay, I like the upfront cash value, but I'm more comfortable taking a little bit of it, more of a hit up front, but going with, call it a $30,000 minimum premium and a more traditional product like most of the videos on our channel display. Anyway, it works if I'm looking at $500K per year or more than that. A lot of times my age will have an impact on that too. But where it can look really good is if I'm paying one more than $500K per year in, or if I've got a large initial lump sum, which we're going to look at that in one of our sample illustrations. So before I zip over to that, let's progress over here to the left. We're going to look at an individual where his plan is A, to maximize cash value, then use the policy for business. The death benefit provides protection for his business. In the event anything happens to him, he's got key man coverage. The cash value he can access like a personal line of credit, and it is an asset on his balance sheet as well. So the sample illustrations we will look at are as follows. The first two will be identical with one difference, $500K per year for 7 years, then $500K per year for 7 years, and then continuously paying that base premium through year 30, the $100K base premium. And then what does it look like with a $2 million initial lump sum and then $500K per year, years 2 through 20. And with the first two options, we're going to look at the basic dividend rate. And then with the $2 million option, we're going to illustrate the indexed rider, just because a lot of times when we see cases like this, it's often looked at as an alternative to a variable life insurance product. So an indexed rider does grant a little bit more potential. And again, that indexed rider, it's just a rider. So if we attach it and then the individual says, hey, I just want to go with the basic dividend, can I do that after the fact? The answer is yes, it's very easy. We can adjust the indexed rider, go back and forth between dividend and indexing every year. You can go 50% dividend, 50% index. You can be creative there. Let's take a look at the numbers. So, got our comparison sheet up here. Let me just go through the illustration first, because this is different than traditional policies. What do we see here? Top right-hand corner, you see annual premium. This is your base premium right here. $100,000. This is as low as we can go. Unless you're a business owner and you've got a number of employees and you're looking at a policy for your company, it's a little bit different. Then we've got our PUA rider at $400K. Now it's scheduled. This can be unscheduled. So typically a case like this, we see the $100K premium buys him a death benefit of $4.7 million. That's the whole life death benefit. Then we've got this term rider attached. Purpose of the term, cost-effective way to add more death benefit. Now why we're adding more death benefit to get a total of $13 million is to prevent the MEC from occurring. He wants to be able to pay in $500K per year for at least 7 years. If he didn't have that term rider attached, he would not be able to go up to $500K. He would trigger a MEC. So term rider, cost-effective way to add more MEC space. So how most people set these up, or as far as what they commit to, is as follows. You've got the $100K base. Here's the cost of the term rider, $3,000 and change. A lot of times we'll see something like this, or here's how we'll set it up, where an individual is committed, call it to 105 per year. Maybe it's 110. They're covering the base plus the cost of the term rider, and then adding additional funds to the PUA rider on an unscheduled basis, meaning at their discretion. Here, we just made it scheduled to show the $500K per year going in. Look at the first year cash value. So actually what I want to hit on first, over here, base policy annual premium and base guaranteed cash value. This represents the cash value generated from the base premium payments, and it also assumes only the guaranteed rate is applied to it, no dividends or anything like that. But the purpose of this, here's my $100K premium. With the traditional product, this would be 0, or a very small percentage of the $100K. We've got 95% immediately. Now, When we look at our net cash value, 500 goes in. You've got 461 and change. It's not 95%. It's a little bit less. You're closer to 92. And what you can do is just take your first year cash value, 461, 284, divide it by your payment. I hit the multiplier by accident, 461, 284, divided by 500,000. There's your first year cash value percentage. So you paid in 500, you've got 461 and change, about 92%. So why do we only have 92% of our total payment when we had 95% of our base premium? The reason why has to do with the PUA fees more than anything else. The term rider cost does take a little bit out. That's $3,100 and change. So yes, it does kick it down maybe another percentage point, but it's minimal with the PUA fees. The net cash value, however, does reflect the net value, net of all fees and everything. So if I look at this, year one, get 92%. Year two, I pay in 500K, get just about all of it back. Then I'm positive year three. What I'll add is even with the PUA fees, if I max it out, I will see the strongest internal rate of return, the strongest overall growth rate, with the exception of really the first couple of years where those PUA fees and premium costs and everything do exceed the earnings in the policy. The early years and the startup costs, that's what everyone dislikes about whole life insurance because I've got less than what I pay in. Break even, very close to year four in this example. I paid in $2 million, I have 1,972. Year five is my break-even point in this particular case. So that's the detailed illustration. You've got the $100,000 base premium. Let me look at that, or let's take a look at that $2 million lump sum example. So here, look at that first year outlay, $2 million. However, has that base premium changed? It has not. We're taking advantage of Guardian's 50x rule. We're not going quite 50x, but we stuffed a lot into the policy in the first year, 40 times the base premium when we look at it. 20 times. $2 million in, $100,000 base premium, really 5% of the total first year payment. But as we look at this, what do we see? $2 million in the first year, base premium has not changed. What has changed? Cash value's changed, but the death benefit's significantly greater. Why is it so much higher? The reason why, again, has to do with the MEC limit. So this MEC limit is a little bit north of $2 million, which we needed to have that death benefit to be able to pay that much in. If we go any lower, then we trigger a taxable event. Here's the term rider. Here's the term rider cost in the first year. And you will see this term rider decrease over time. We can also chop it off if needed. However, with that huge PUA payment, the interest earned based on the guaranteed rate and dividends is going to quickly exceed the expenses of that term rider and everything else on the policy, and it'll look good. So this illustration here does assume the indexing. So we can look at the dividend as well. Indexing does not kick in until policy year 4 on these illustrations, meaning the first 3 years, it's assuming just the basic dividend rate. By year 3, $3 million is paid in, you're getting close to $3 million. By year 4, you are positive. 3.5 in, 3.54, $2 million in cash value, and a massive death benefit. So also, aside from business protection, we'll sometimes have things set up where you've got estate protection as well, where a trust may own the policy or it does own the policy, and then it specifies how much of the proceeds are paid to the trust or how much are separate designated for one's estate for personal estate planning, and then also to the business for business protection. Maybe there's 2 separate policies in a case like this, but there's a lot that goes into that. Anyway, let's go back here to the comparison sheet, shall we? So on the left, the $500K per year, total payment for 7 years, minimum payment, a minimum premium this is of $100,000. The true minimum would be about $105. But here, base premium, PUA at $400, total of $500. There's your cash value, breaking even between years 4 and 5. After 7 years, so here we just funded for 7 years, then hit the kill switch, eliminated the premium with a reduced paid up, cut the term rider, paid nothing into the policy, cash value continues to grow. Strong asset, very attractive death benefit as well. Death benefit proceeds are always paid out income tax free. Now, death benefit proceeds are not exempt from one's taxable estate. So if you own a policy this size individually, this is going to be included with all of your other assets. Could be looking at the estate tax limit there. You may very well be over it. So if that's the case, that's where you definitely want to consult with an attorney. We can always make an introduction. There's one group that I trust, which we've got podcasts with them, EMA Legal, and Elizabeth Morgan runs that office. But my point is, if you've got a large taxable estate and a death benefit this size or larger, you may want to do some planning or at least prepare to make some moves in the future. Or not, it's always up to you. But it's good to have awareness, in my opinion. Same option here, with one difference. After the 7th year, stop making PUA payments. We can continue to make PUA payments here, by the way. The term rider expires, but we could still pay in easily another $100K per year into PUAs. Through the 10th year, we could pay another $300K into PUAs. Like, we've got some room to add more, no problem. But here, we just showed the base premium. What's it look like? So my total payment matches the base. And all I'm doing is feeding the beast here. And then you've got the large lump sum scenario with the $2 million lump sum and indexing the dividend. Look at that break even between years 3 and 4. Attractive on the balance sheet, upfront and long term. And the last thing we look at in a case like this is the annual and average internal rate of return. So we want to look at the good one first. Check this out. The good one. The shiny one, I should say. That is not guaranteed by any means. So the annual IRR is easy to punch in. But for the average, we can just pull it from the company's software. We also have our own formula. We actually got this from someone who purchased a policy from us. He was nice enough to share his knowledge on how to do that, which we sincerely appreciate. There we go. So there's my annual and average internal rate of return over time. And there's things we can be creative to juice that a little bit. If we cut the term rider, shorten the funding period, look at a reduced paid up. But in any event, I mean, that's pretty attractive. And that is a tax-free internal rate of return if we do everything properly, meaning don't trigger a MEC or another taxable event. Annual IRR, average IRR. But that's the kind of stuff we look at, particularly with these bigger products or bigger dollar amounts. And if we're not showing it, it's being asked for, not always by the individual taking out the policy, but sometimes their advisors as well, because it's a thorough analysis, or a thorough analysis has to be done. So what we always try and do is provide it up front, just because I know what's going to be asked regarding the product from the advisor, whether it's the CFO, whether it's an attorney, CPA, whoever it might be. Try and provide it up front to make life as easy as possible for the individuals, and that tends to create a healthy relationship as well. Because if I'm working with you, if you've got this policy and you also have other advisors and such, my goal, what I don't want to do, I should say, is argue and fight with them, which I've seen happen too much in this industry. I think it happens in all industries, but it's like, no. Instead, my goal is to work with you, so I've got to be willing to work with your entire team, which we are, and that's where we're just going to make life easy and show all the options, make it transparent, and that way everybody can make an informed decision. In any event, I hope you enjoyed this. If you have any questions, feel free to email us or leave them in the comments below. If you enjoyed the video, please hit the like button and subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.